Good afternoon, everyone. It's my great pleasure to welcome you all to Friday Connect. With this series, we try to bring to you an update on all Edelweiss equity and hybrid funds. In today's series, we're going to talk about Edelweiss Large and Midcap Fund. This fund has been in existence for more than 15 years. In its earlier avatar, this fund used to be called JP Morgan India Equity Fund. And post 2016, when we took over the JP Morgan assets, the fund has been named as Edelweiss Large and Midcap Fund. The fund's AUM is upwards of 2,000 crore and is currently managed by Abhishek Gupta. Just to give you some background about Abhishek joined Edelweiss 2 years ago. Before that, he have had a very long stint with Goldman Sachs Asset Management, also worked with Deutsche Asset Management and Nippon Asset Management, previously known as Reliance Mutual Fund. Abhishek also has covered various sectors, especially the industrials, extensively for over 17-18 years. In a unique structure that Edelweiss follows, I would like to bring to your attention that all the fund managers that manage our money are also responsible for being analysts for one or two sectors. So in today's discussion, I would request Abhishek to not only talk about the fund itself, but also throw some light on the sectors that he covers. Without taking much of your time, I would invite Abhishek onto the dais and hand over the floor to him.
Thanks, Deepak. I hope I'm audible. Good evening, everyone. So as Deepak has said, maybe how I intend to have the flow of this discussion is in the first 15 minutes, let me kind of enumerate why large and mid as a strategy should be something which should be core for any investment philosophy. We'll touch upon how we are right now constructing the fund, what are our sectoral bets, how we are positioned from a positioning perspective. Maybe during that discussion, I'll also enumerate and touch upon the sectors which I lead and exactly what is my view in specific to that sector, irrespective of how it is positioned in the fund. Is that good as a flow, Deepak? And then we'll open it up for Q&A.
Excellent.
Perfect. Okay. So let me just share my slide. I hope this is visible. Okay. I take it as yes. So let me start with, as I said, normally there is always a question that why someone consider large and mid or a small, how should one bifurcate their current holding or the mutual fund? So typically I start with this slide where I just take you through the reasons to own large and mid as a strategy. And I believe why so firmly that it should be core as a strategy for you. So typically what you will look when you make an investment in a mutual fund, right? You typically like for businesses or the mutual funds, which are, let's say, less volatile, which gives you good enough breadth of the market, which has got ample diversification to take out idiosyncrasies of market, and which has over a rolling period of time generated you positive return. On those four lenses, let me kind of take you through how large and mid cap as a strategy work. So as you can see on this slide, on your left-hand side is the standard deviation what we have mapped across various indices. And mind you, these are indices, so I'm not even using any particular fund. It's just the broader segment as such. So if you compare Nifty 50, Nifty large and mid 250, Nifty mid cap or a small cap, Nifty large and mid has surprisingly lowest volatility, which is akin to kind of minimizing the risk exposure which you will have depending upon how the volatile the markets are. So clearly it's a lesser volatile portfolio construction. If you look at on your right hand side of the screen, this is about the breadth of the market. So if you look at the overall breadth which is available from a benchmark construction perspective, Nifty large and mid is an index which gives you the biggest breadth in the sense that you can invest in wider set of names as a benchmark constituents, and hence you have wider participation to the market. Along with that, as I said, another important factor which I want to talk about is this. Not only it's the widest when it comes to the market breadth, it is lesser volatile versus the other larger peers, but it is also a very well diversified and constructed benchmark. So here I've done representation of talking about how you compare, let's say, weights of Nifty 50, you compare the weights of Nifty mid cap 150 versus the large and mid 250. You will see in most of the places, it's a very well represented and diversified ownership, which comes within a large and a mid cap category of 250. So maybe just quote you some examples. Let's say the FMCG space. I mean, it's about 9.7% weight in your 50-50, but it's much better represented with about a 6% weight in large mid-cap. Similarly, you go to space like banking, right? So if you look at financial services, almost 38.5% of the weight is represented by financial services, while the same is moderate to 28.5% in large and mid. There are few sectors which are completely missing from Nifty 50. Let's say capital goods. There is practically no representation of capital goods in Nifty 50, and we all know how strong the capital good as a segment has been for last 2 years. And hence, if you look at large and mid, you have almost 6.5-7% exposure. Similarly, healthcare, automobile. So these are sectors which are underrepresented in Nifty 50, but very well represented in large and mid. And vice versa, there are a few sectors which are underrepresented in mid cap 150. So broader point to take away from here is it's a very well diversified constructed portfolio. Lastly, as I said, from a benchmark perspective, you also like to own businesses which have the ability, or the funds which have the ability to outperform a period of time. So this is what we have done. We plotted a large and mid 250 versus your Nifty 50. And as you can see, over a rolling period of time, to take away any benefit of any specific time frame, on 3, 5, 7, and 10 years, Nifty 250 has outperformed Nifty 50 by 66% of the time, 76% of the time, 88% of the time, and 100% of the time. So net, what we are communicating is it's an index which is very well represented, which has got broader breadth, which has got lower standard deviation, and which is something which has over longer period of time had a tendency to outperform broader markets. If that is the broader premise on which a large and mid as a strategy is constituted, I very well believe this should be a core strategy for anyone to hold to. Now, having explained reasons why one should be owning and just encapsulating what exactly large and mid cap strategy is, just for the benefit of everyone, by definition, you need to have about 35% minimum exposure in both categories of large cap and mid cap. By definition, large cap is the top 100 names of the market. Ranking 101 to 250 would be classified as mid cap, and anything below 250 will be called as small cap. So if you look at the construct, it's a very well constituted product also, where you have at any point of time almost 70% of exposure dominated by large and mid. And the remaining 30% is at the discretion of the fund manager, how he wants to allocate it depending upon his and her personal biases and opinion when it comes to the market and the stock selection. With that as a backdrop, now let me touch upon our investment thesis very quickly, and then I'll touch upon the fund. On the investment thesis, I think this is something which we all live by with. We call this as a FAIR, which is predominantly our investment framework. To make it easier, let me kind of just say that this is how we kind of split this FAIR. Okay, so let me first enumerate what FAIR stands for. So F stands for forensics for us, A accepts or acceptable price, E for ESG inform, and R for robustness of the business model. For making it easier, let's just think through in two broader buckets. One is the corporate governance / ESG framework, and the other is the fundamental aspects where you evaluate business in terms of its robustness and where you evaluate business in terms of its the valuation parameters. So these two criteria is something which we use as the broader guardrails for us. When it comes to the ESG and the forensics and the corporate governance aspect, again, I think these are more gatekeeper for us to make sure that whenever there is an idea which we are evaluating and where maybe we don't have a history of ownership, we will like to run it through a screen of forensics as well as on the corporate governance side to make sure that we are not getting into businesses where there could be a possibility of a shock which will eventually impact our holding. So that's the screener which we run from a governance aspect. If I talk about the fundamental aspect, as I said, we run a framework like the robustness of the business and then ultimately acceptable price. So to make it easier, there are a few parameters which we have used to call out our robustness framework, which is basically the fund should be able to generate to return, which is more than cost of capital, which is the first point which we have highlighted, which is 5-year ROIs should be more than 10%. Similarly, we also look at business which should be on a northward growth trajectory. So both your EBITDA and PAT should be higher than last 5-year average, as well as we also look at whether the business or the core entity which we're evaluating versus the sector has been able to generate alpha, and hence revenue growth should be better than the average sector growth. These three framework basically encapsulate in our understanding what is a robust business framework. Once you use that and you superimpose your own valuation framework, which is more of a in-house developed tool where we kind of rehash, it's a rehash version of DCF. These three coming together gives you a kind of a framework on which we go to the stock selection process. Coming to what we do, I've already mentioned to you. Let me just quickly touch upon again few of the guardrails which we have called out, and this is something which we follow at a firm-wide level when it comes to long equity. We don't want to kind of be somebody who wants to take a more top-down view. We don't necessarily take cash calls because we believe cash call is akin to taking a market timing call. And more often than not, it's not a source of alpha generation over a longer period of time. Similarly, we don't kind of take views which are more macro driven, or where we tend to take a benchmark hugging position just to make sure that we kind of minimize the portfolio active calls. Because as again a portfolio construction strategy, we strongly believe that our strategy overall, or our construction framework overall, should focus on a bottom-up stock selection approach. Hence, taking macro call or benchmark hugging takes away the opportunity for us from a portfolio construction perspective when it comes to creating alpha opportunity. So these are few factors which we have called out, which we'll not be doing. Lastly, touching upon the fund, as Deepak said, that I mean, there are various sectors which we kind of at this moment are preferring. If I call out few of them, if you look at on this slide on the bottom right side, industrials, cement, auto ancillaries, these are few segments where we have a positive outlook. There are sectors which are more global oriented, may it power and gas, may it healthcare, may it technology. These are the sectors where we are right now underexposed, or where we are maintaining a underweight. To touch upon themes, before that, let me just take you through the construct of the portfolio at this moment. This is a little dated slide, but when it comes to the overall composition, almost 51% of our large cap portfolio is exposed to large cap at this moment. There is about a 38% exposure to mid cap, and there is about a 8.5-9% exposure to the small cap. That's how well fragmented the overall portfolio is. And if you look at again the exposure wise, you will see we have got quite a good name when it comes to the overall holding. But when I talk about specifically the active weights, because that is what I think is most relevant, there'll be names which are well represented within the space of materials, in the names like as financial as a space, also as well as consumer discretionary. So these are few spaces where we have pretty strong ownership when it comes to the overall exposure. Now coming to the themes, and that is where I'll also double up on the few sectors, or double down on the sectors which I cover actively. So first of all, if you look at the current exposure of a portfolio, we are very well represented by three broader themes. It's domestic cyclical recovery, which is again subcomponents would be realty, automobile, consumer durables, and the financial space. The global sourcing hub, which we believe is again a more decadal theme, which is a story which is evolving, like playing on EMS space, chemicals, maybe technology evolution. So that's the space which is global sourcing, where we are playing China plus one opportunity, Europe plus one opportunity. And lastly, the domestic capex recovery. As I said, there has been a pretty strong nascent recovery signs which we are getting in terms of the overall capex recovery. And as and when it plays out, that is another part of the story which we really like. I think let me just take you through some examples here to make it much easier for us to comprehend. Let's just probably pick up the domestic capex recovery, and this is also a space which I actively cover. So maybe it will also help you to kind of understand what ideologies we are working with. I think if you look at over last 15-18 years, post 2007, India actually went through a lull phase when it came to private capex. If you look at the most of the capex which was seen in the decade of 2010 to 2020, it was predominantly done by the central and the state, more by central, lesser by state. And the main factor for that also was because there was a bunching of a capacity which came through in the later part of the decade of 2000 to 2010, and then the world faced global financial crisis. Came 2010 to 2020, India faced issues like the Fragile Five. Then we all face issues like demonetization, GST implementation. So a lot of regulatory changes were coming through. And during that turmoil, the overall industrial recovery phase was at a slower pace. And what this led to, the countrywide capacity utilization, which is a yardstick or a benchmark we use to understand that how the capacities are getting sweated at a macro level. Typically, whenever this number hits a 78-79% kind of capacity utilization factor at a countrywide level, we see the capex recovery cycle becoming very prominent. In the decade of 2010 to 2020, we hit a bottom of about 64%. At this moment, as we speak, the capacity utilization factors are about 74-75%. It's much nearer to the top. And that is why if you kind of just correlate this data with the order book accretion, which you have seen for most of the capital goods / industrial players, you would see the order book ballooning by 30%, 25% CAGR over the last 2 years. The revenue visibility is clearly playing out, and the margin trajectory, which is typically the operating leverage for this space, is also working. So that is one area where we're positive upon. We also will like to touch upon areas like PLI, which we believe is a very important area to focus upon. So this is a data which we have put across. If you look at the PLI so far committed, there is almost a 4.5 lakh crores of capex which is committed towards the PLI till date. Of that, almost 2.4 lakh crores, so almost 55% of that capex is going to be sponsored by the center itself in the form of the grants, in the form of your incentives when you commission your capacities. So just think through from an industrialist perspective. India has been going through or taking care of all the challenges when it comes to factor of production, right from labor law reforms to now land availability, which has been kind of given as a right to the state to figure out. And lastly, the cost of capital, which was an area of concern. So as per international norms, India could not afford to give direct benefits because that will be against global WTO norms. But you can always give incentives linked to production, and that is where this whole scheme was formed. To summarize this scheme, as I said, this 4.5 lakh crore capex, assuming all capacities which are committed become operational by end of next 5 years, from the 6th year onward, this has the capacity to generate almost 10 lakh crores of revenue, which in terms of the India's GDP would be almost incremental 3% GDP creation just by this one initiative. Add to that, we are talking about creating jobs of the magnitude of almost 40 lakh employees. So almost a 4 million kind of an incremental job creation opportunity. There is the capex requirement, which will fund the engineering sector right now, and eventually will add to the GDP of the country. So, I mean, these kind of schemes which are helping us to kind of become again more manufacturing focused, become more export oriented, is something again as a theme which we really like. So this was on domestic capex recovery. Quickly touching upon domestic cyclical recovery, that's another space where we're positive upon. So again, we have seen in India with the benefit of our per capita income hitting upwards of $2,000, it's typically a nascent side where typically the consumption, and this is more on discretionary side, but in general, you hit a J curve. So the moment a nation's per capita income hits a $2,000 number, you typically see consumption which is getting boom more in terms of discretionary spends like automobile, maybe in terms of your vacations, your air travel, so your movie going experiences, your mall consumption, so all those things which are more related to discretionary part of the spends. We believe that this is again a nascent part of the recovery because in last 15-18 months, inflation has impacted the consumption basket more for the lower strata of the economy, and that is why that recovery is yet to play out. We have exposure to segments like automobiles, where we believe again the whole consumption or rather the recovery is just playing out. We also have pretty good exposure to the lending financials, which basically is a proxy to the overall macro recovery. We have exposure to affordable housing. We have again exposed ourselves to reality recovery or the real estate recovery by exposing ourselves to building material rather than directly taking exposure to real estate, because again real estate we find some governance aspects which don't meet our expectation. Hence we have exposures in companies which are exposed to tiles, fans, paints, plumbing pipes, and that way we're exposing ourselves to reality as a space. I think this is the sum total of what I wanted to touch upon. I think I'll take a pause here. I'll be happy to take questions or if anything specific which I would have missed out. Deepak, if you want to highlight, I'll probably touch upon that also.
So Abhishek, why don't we talk about the recent lag in some of the performance metrics that we have witnessed in last 6 to 9 months.
Sure.
What can be attributable to that change? Because just about 6 to 8 months ago, the fund was Q1 across time periods. And if you look at it today, it slipped into Q2.
Yeah.
So how would you like to explain that?
No, I take this point, Deepak, and thanks for highlighting and reminding me to discuss about it. So again, I think if I can just touch upon, right? I mean, there are few factors which is one needs to understand how the construct of the portfolio is. And there would be bouts and instances where if that thesis or if that style of investments is not holding true in the market condition, we may have these periods of underperformance. So let me kind of take you through two instances which played out. So as you said, Last year, if you look at, we were doing pretty well for on trailing basis as well as on 1 year basis. But with the geopolitical tension which came through in the early part of the calendar 22, along with the inflation risk which played out in the later part of the year, you saw a sudden rise in the overall interest rate across the world, the monetary policy tightening. What this led to was a sudden increase in the cost of equity, cost of fund. In a typical environment where the cost of equity rise at such a fast clip, you typically see that the value becomes the center stage when it comes to investment choice rather than the growth. And any business which is on the higher side of the valuation typically gets impacted the most. Now, when you look from that lens, the PSUs and more specifically PNSU Bank as a bucket did fairly well in the month of November and December. That was one point of time where we were kind of evaluating. We were in the process of finding out right ideas, but we got a little late in terms of selecting the stocks, and the impact was felt on the portfolio. So the change of style from growth to value in a short span of 1 month, and the portfolio obviously does not tilt in such a short duration, impacted the performance at that point of the time. Then if you look at the YTD so far, we were doing fairly fine. We did capture rather a pretty strong recovery, which was played from mid of March to end of June. If you see, we were able to capture most of the upside. And then again, the rotation came into play. So if you look at from June onwards, what has happened is, given the bout of outperformance by the sectoral leaders, there was a rotation which came into play. Again here, were the second tier names within the sectoral versus the sectoral leaders. There was a rotation from sector leaders to the second tier, third tier name. And that is where, again, due to our fair construct, where we weren't very comfortable with either the governance aspect of those businesses or the management, or clearly because we are true to label. And hence, when we have called out publicly that our large to mid will always have 90% plus exposure in the mid and large, and if you recollect, the last 5-6 months has been led all by small cap rally. So that also to some extent had a negative bearing in terms of our impact in the performance. So I think the bouts where you see a sudden change in the style, and where there again, where there are specific sector which perform at a much faster clip, those will be the bouts where we may have some amount of pressure in terms of performance. But having said that, obviously we are mindful of the performance, and we did this whole analysis running all the way to last 15-18 months to find out that what is working for us, what is not. To the benefit of all, I think the good data here is that on whole of last 18 months, at various point of time, whenever we did this attribution analysis, our allocation, sectoral allocation call has worked positively. So clearly we are doing right when it comes to selecting the right sector at any given point of time in the economy. Where we need to do more work is to avoid the omission part of the selection. So the name which we did not own and those name ran up at a much faster clip, that is where there's some more amount of work needs to be done. But clearly this is something which is work in progress, and we are focusing on it.
So thanks a lot, Abhishek. Let me just move the discussion in a different direction today. Globally, when we talk about oil as a segment, and when we talk about leadership, the word Saudi Arabia comes to mind. And when we look at data, they are oil exporters to the tune of $170-180 billion. India is also a behemoth in that sense when it comes to IT. That business is close to $180-200 billion. You cover IT sector like anything. But the ITs of the early 2000 era and the IT of today have seen a big paradigm shift. How would you explain? Could you plus throw some light on explaining the contours of the IT sector? How is it moving? How Indian companies are changing their business model to align with the global needs?
Sure. No, so clearly, I think this is a space which is very close to me. I've tracked this space for last more than 15-16 years. And I can tell you, as you said, right, the evolution is so stark when you compare and see at what scale Indian IT has been able to deliver. Just to again give you some data points, if you look at the overall IT done from India, And given it is not manufacturing exports, it's not counted as part of a pure export basket. Merchandise exports is seen more as a part of your services and invisible. India exports about $150 billion of exports when it comes to technology services on annual basis. So you can clearly understand the magnitude. If you kind of just compare and contrast with that, I think the current import basket of India's energy requirement, and I may be off by a few $1 billion here and there, but we are almost 80% of India's oil import bill today has been taken care by the IT services itself. Assuming the fact that even if we want to assume, and I'm just going by the projections of the Indian Energy Association, that the energy requirement in India will grow more at a single digit levels between 3 to 5% annually. And if the Indian technology exports is expected to continue in high single digit to touching double digit kind of a number, we are not far off maybe in next 5 years when India's technology export as a basket will be bigger than India's energy import basket. So that's the kind of magnitude of delta you're talking about, which we have seen over the last 15 years. Now double clicking into the IT as a space per se, right? I mean, it's a humongous space. There is no question to it. There are cities like Hyderabad, Bangalore, Pune, which have just developed on IT services as an offering. To call it out, I think Indian IT services at this moment employs almost 5 million people. So 50 lakh plus people are already employed in this segment. If we look at the biggest name right now, which are Infosys, TCS, Wipros of the world, you will be surprised to know from someone who was, or from companies which were maybe in the early stage of evolution in the early 2000, we are now among the top 10, 15 IT service providers individually at a global scale. So if I can just talk about pure services players, somebody like Accenture, who would have a revenue run rate of almost as $55-60 billion, you compare and contrast that with somebody like TCS, which has already hit a revenue run rate of upwards of $25-26 billion, Infosys is 18 billion, and then you have Wipros and HCL of the world, which are again double-digit $10-12 billion kind of revenue run rate. So clearly, we are no more the challenger in this space. We have clearly established ourselves. And the good data point, which is again worth highlighting here, is that if you look at any of the third party or the third party consultant data in terms of technology in India or globally, the technology spend globally is expanding between 3 to 5% annually. Now, if you compare that again with the data which I called out earlier, that Indian technology is expected to grow at 8 to 10% minimum over a period of next 5-7 years, our market share will only keep expanding from here on also. So I think it's a very strong enabler. Not only does it create job, but also important point here is that if you look at from a perspective of consumption basket, right? This is again a sector which is fueling the whole Indian consumption story, because most of the IT employees across these major cities are the ones who are actually the consumer class, who are the ones who are buying the Royal Enfield bikes. These are the people who are actually buying investing really initially in the real estate. These are the people who are taking vacations, foreign vacations. So clearly the whole boom which has been seen to a great extent has been kind of led by this whole IT boom in India, and hence its importance could not be enumerated further.
So I would request all the participants to put their question on the chat box, and we'll take as many questions as you all want to ask. In case there are no questions in next few minutes, I would wind up the call. But let me move on to my next question, Abhishek. There's a lot of talk about AI, chat GPT, and tech is synonymous with disruption. What kind of disruption do you think that, and say we have been talking a lot about it, but to, let's say, to put some time bound perspective in next 3 to 5 years, what kind of a changes do you see which are led by some of these names that we just mentioned, AI and...
So Deepak, interestingly, in last 3 decades, starting from 2005 when I started my career, in all 3 decades, at different point of time, I have heard one big disruptor which has impacted Indian technology as a space. 2005, it was the ERP wave, when everyone was concerned that we are just the body shoppers, we don't know how to run the ERP wave part, and we don't have enough skill set. And 5-7 years went by, and you will be surprised to know that Indian players became one of the biggest system integrator, which are the players who help to integrate the ERP software. Then came 2015-16 when everyone was worried about SMAC, which was called at that point of time, and then eventually it was called digital. So again, people used to worry about this whole cloudification, this whole ubiquity of technology, right? Those are the aspects where everyone worried about. That Indian players again will not have much work to do with the service providers or the software as a service, SaaS, which we call it, would take the center stage. What happened? We have all seen in last just give me a minute. You have to give me a minute. Just give me a pause. So kind of just coming back, what I was telling you is that if you look at the SMAC, again, it was something which was people was worried about, and we all have seen how strongly the Indian IT grew when it came to implementation. Now, obviously, I'm not dismissing anything, right? I mean, clearly these are enablers in a way, which not only helps to increase productivity at a wider level, but it also, if you think at a mankind level, releases the man-hours which would have otherwise been wasted, and that could be utilized in a far better fashion. With that as a backdrop, do I take any side of the argument at this moment, whether it will be positive or negative? I think the jury is still out. The general interpretation, and I agree to that, concur with that at this moment, is that there would be the release of man-hours clearly, because the repetitive work, the iterative work will become much easier and much shorter to implement. How do we utilize those man-hours available is something which has yet to be seen. Would it have a deflationary impact at the overall services revenue? I think it's too early to call out. When you talk about the timelines, I think, again, looking by what we have seen historically in the last two waves, it's at least a 5-year phenomenon before you can make it center stage. Although, to be fair, generative AI is the most often used work right now on all the calls. So clearly the whole industry is warming up to it. They are using their test cases, they're building proof of concept, but minimum 3, realistically 5 years is the time frame where we will have an absolute benefit of it. And I don't think it will be negative. Yes, it will just create more opportunities, which will be actually positive for everyone.
Okay, so there are no questions, Abhishek. Thank you so much for your time. I really appreciate it. Thank you, participants, for logging in. We will come back again with another fund, another speaker. Until then, have a good weekend. Thank you again for joining. Thank you so much.
Thanks, Deepak, and thanks everyone for being here. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.